Hello viewers. Welcome to our today's lesson. This video is made to give you 7 chart patterns strategy. You will learn how to draw 7 chart patterns and how to take entry on those 7 powerful patterns with examples. This is Forex Learning School channel. This is an online educational portal. In this channel, you will find chart analysis, profitable strategy and many more. Let's begin today's lesson. Do technical analysis and chart patterns really work? The answer is yes. It works. In this video, you can learn everything about chart pattern strategy. The formula for success in trading. 1. Find a trading style that matches your personality. 2. Develop a strategy according to the trading style. 3. Stick to the strategy. The 7 chart patterns for successful trading. 1. Support and resistance. 2. Trend line break and reversal. 3. Head and shoulders. 4. Fibonacci retracements. 5. Double tops and bottoms. 6. Triple tops and bottoms. 7. Triangles. Chart patterns are an integral aspect of technical analysis, but they require some getting used to before they can be used effectively. To help you get to grips with them, here are 7 chart patterns every trader needs to know. A chart pattern is a shape within a price chart that helps to suggest what prices might do next, based on what they have done in the past. Chart patterns are the basis of technical analysis and require a trader to know exactly what they are looking at, as well as what they are looking for. Chart pattern 1. Support and resistance. Forex support and resistance levels is the most important concept in trading you will ever learn and master as a professional or full-time trader. That is why drawing those levels perfectly and neatly with minimal error is very crucial for successful trading. Your ability of drawing those levels professionally is the difference between a successful and unsuccessful trader. That is why it is very important that you grasp the whole concept of drawing those levels perfectly, otherwise you will not be able to trade successfully. Winning and losing traders both draw those levels, but the thing that separates winners from losers is the right selection and drawing of support and resistance levels for trading the Forex market. Now, we will learn how to identify and draw support and resistance levels on any chart. Horizontal support and resistance levels are the most basic type of these levels. They're simply identified by a horizontal line. First, you need to spot a past price level where the price had difficulties to break above or below. Then mark it with a horizontal line which rays into the future. Once the price approaches this horizontal line again, there is a high chance that the price will retrace from that line. 3 simple rules to draw perfect support and resistance levels. Rule number 1. The market needs to get rejected at least twice from the level, not twice. Rule number 2. The more rejections the level has, the more important it becomes. Rule number 3. Most recent rejections are more important than less recent rejections. There is one rule that I always follow. Only take on consideration the support and resistance levels that the market is actually taking in consideration. Why would I act based on a level that the market is responding to? Right. One important thing to consider. Support and resistance levels are more like zones instead of levels. So don't break your head trying to figure out where to draw your level. At close of the candlestick, at the lowest low, etc. Just draw it where it touches the most rejections. Here is an example of support and resistance level. This GBP USD daily chart. We have drawn horizontal support and resistance level on the chart. Here you can see the breakout of resistance level. You need to open trade when resistance will be broken. You can see the price rally after broken of resistance level. Thus, you will find trades set up after resistance breakout. Did you know? Once broken, support and resistance levels change their roles. A previous support level becomes resistance, and a previous resistance level becomes support. Here is another example of this chart pattern. Here in this chart, price broke resistance level and then come again to retest again. You can also take entry when price comes to retest again. One pro tips for you. If the price reaches a support level at the 1 hour chart, but the daily chart shows that the exact same price level could act as a resistance, there is a much higher chance that the price will respect the daily resistance and break through the 1 hour support. This example is for support level breakout. You can also take entry when price breaks support level. See the result on the chart. This is daily chart. After breakout of support level, price fell more than 1500 pips. So, you can imagine now about the power of support and resistance. Chart pattern 2. Trend line. A trend line is probably the most basic tool in the technical trader's toolbox. They are easy to understand and can be used in combination with any other tools you might already be using. By definition, a trend line is a line connecting two or more lows or two or more highs, with the lines projected out into the future. Ideally, traders look at these extended lines and trade on prices reacting around them, either trading a bounce of the trend line. Trend lines are a staple for technical Forex traders that can be used on any currency pair and on any time frame. There are two types of trend line. One is uptrend line, another is downtrend line. Now you will learn about uptrend line. The uptrend line is composed of several support positions, high points, and a support trend line can be drawn by two or more support positions. It is common for buyers to buy in the support levels. Downtrend line. The downtrend line, also known as the pressure trend line, consists of several resistance levels, low points. Two or more resistance levels form a resistance trend line. It is common for sellers to sell in the resistance levels. Tips 1. Connect swing lows to swing lows. We want to draw a line connecting either two or more swing lows or two or more swing highs. For those unfamiliar with the term swing highs lows, we simply mean the peaks and valleys created with zigzagging prices. Once we connect peaks with other peaks or valleys with other valleys, we want to see the line not being broken by any candle between those 2 points. Take the examples. Trend line support and resistance levels are not drawn by horizontal lines, but by trend lines which can be upward sloping or downward sloping. Since the Forex market likes to trend, trend lines are often used to identify uptrends and downtrends. Each time the price approaches towards a trend line, there is a high chance that the price will bounce off the trend line. Just like with horizontal support and resistance levels, the trend line should have at least 3 price touches before it is considered important. Tips 2. The more connecting points, it gives better results. To truly validate a trend line, you need to see the price actually react from a line projected from a trend line drawn based off of 2 prior points. Essentially, a third high-low is needed to truly solidify a trend line. Once you have this, you can then feel better about looking for opportunities to exploit the market when price reaches the trend line again. While having a third high-low is recommended before looking for a trade, it is not required. Aiming for an entry on point number 3 below could work out just fine. Tips 3. Buy bullish trend lines, sell bearish trend lines. The trend is your friend. This popular rule also applies to trading trend lines. For experienced traders, this basically means we should only look to buy at bullish support lines and sell at bearish resistance lines. For traders not into trading jargon, let the following images below explain this to you. How to trade with trend line. After a trend line has formed, we look for reversals when price moves in proximity to the trend line and pulls back, but also watch for breaks through it. Either event can be significant and predict the next price move. Here is an example of trend line and its breakout. You can see on the chart, price breaks trend line and fall. So you take entry from the breakout levels. Price fell almost 200 pips after breakout of trend line. Buying tips. Buying bullish support trend lines. An upward bullish trend line means the price has been trending up, so we want to look for buying opportunities. Buying opportunities occur when the price drops down and comes close to the trend line that has caused upward bounces before. Selling tips. A downward bearish trend line means the price has been trending down, so we want to look for selling opportunities. Selling opportunities occur when the price moves up and comes close to the trend line that has caused downward bounces before. Chart pattern 3. Head and shoulder pattern. A head and shoulders pattern is also a trend reversal formation. It is formed by a peak shoulder, followed by a higher peak head, and then another lower peak shoulder. The neckline is drawn by connecting the lowest points of the two troughs. The head is the second peak and is the highest point in the pattern. The two shoulders also form peaks but do not exceed the height of the head. What does a classic head and shoulders top look like? The classic head and shoulders top looks like a human head with shoulders on either side of the head. A perfect example of the pattern has three sharp high points, created by three successive rallies in the price. In this example, we can easily see the head and shoulders pattern. The head is the second peak and is the highest point in the pattern. The two shoulders also form peaks but do not exceed the height of the head. With this formation, we put an entry order below the neckline. We can also calculate a target by measuring the high point of the head to the neckline. This distance is approximately how far the price will move after it breaks the neckline. You can see that once the price goes below the neckline, it makes a move that is at least the size of the distance between the head and the neckline. 4 things must happen to get valid head and shoulders pattern. 1. Market is in an uptrend. To find this pattern, uptrend market is mandatory. 2. Price rises and forms a peak or top, then falls. This first peak price forms is the left shoulder. 3. Then price rises and goes past the first peak, makes a second peak and then falls again. This second peak is called the head. The head is always higher than the left shoulder. 4. Then price rises for the third time but does not go past the second peak, the head, and falls again. This third peak is called the right shoulder. The right shoulders also must not be higher than the head. The head must always be taller than both shoulders. How to trade these patterns? One of the most important things to take into account when executing a trade based on the head and shoulders pattern is to wait until the formation has completed and to only undertake action when there is a confirmation of validity on the head and shoulders pattern. We can confirm the validity of the pattern by waiting for a candle close below or above the neckline, depending on the head and shoulders pattern. Typically, the target after a breakout will be the length from the neckline to the top of the head. 1. You can trade the head and shoulders pattern by waiting for a candle to break through and close below the neckline. The stop loss would go above the right shoulder and the profit target would go the same distance as the head to the neckline, down from the neckline. 2. You can also trade the head and shoulders pattern by waiting for the price to break through the neckline and then wait until it retests the neckline as resistance. The stop loss would go above the resistance level and the profit target would be placed the same distance down from the neckline as the height of the head to the neckline. Chart pattern 4. Fibonacci Retracements. Forex traders use Fibonacci retracements to pinpoint where to place orders for market entry, taking profits and stop loss orders. Fibonacci levels are commonly used in Forex trading to identify and trade off support and resistance levels. After a significant price movement up or down, the new support and resistance levels are often at or near these trend lines. What are Fibonacci numbers? In short, Fibonacci numbers or ratios are mathematically significant numbers that occur throughout nature and often in financial markets. They were discovered by Leonardo da Pisa in the 13th century, and he was known as the most talented mathematician in the Middle Ages. The most popular ratios or levels are 23.6%, 38.2% and 61.8%. There are other ratios that can be used, but it is up to you to decide how far you want to take the analysis. There is also a 1.618 extension along with 2.618. In Forex trading, Fibonacci retracements can identify potential support resistance levels. How to use Fibonacci retracement levels. Fibonacci retracement levels help to provide price levels of support and resistance where a reversal in direction could take place and can be used to establish entry levels. The retracement levels are based on the prior move in the market. After a big rise in price, traders will measure the move from bottom to top to find where price could retrace to before bouncing higher and continuing in the overall trend higher. After a big fall in price, traders will measure the move from top to bottom to find where price can retrace to before correcting lower and continuing in the overall trend lower. How to use a Fibonacci trading strategy. Each trader's strategy will be different, so as a trader you need to consider how each of the strategies below might fit into your overall angle on the market. Not every trader uses the options below, and it is alright if none of them align with your strategy. Strategies that utilize Fibonacci retracements include the following. You can buy near the 38.2% retracement level with a stop loss order placed a little below the 50% level. You can buy near the 50% level with a stop loss order placed a little below the 61.8% level. Let's check a chart. In order to find these Fibonacci retracement levels, you have to find the recent significant swing highs and swings lows. Then, for downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, do the opposite. Click on the swing low and drag the cursor to the most recent swing high. Here we plotted the Fibonacci retracement levels by clicking on the swing low and dragging the cursor to the swing high. The software magically shows you the retracement levels. As you can see from the chart, the Fibonacci retracement levels were shown on the chart. Price pulled back right through the 61.8% level and continued to shoot down over the next couple of hours. Chart pattern 5. Double tops bottoms. The double top pattern is a chart formation consisting of two consecutive price peaks that leads to a bearish reversal. For years, traders have claimed that the double top is a high probability short setup. This is because a double top pattern signifies that bulls are having trouble pushing the price past the prior high. The double bottoms are just opposite of double tops. How these patterns form. Double top and double bottom patterns represent classic models of price behavior that occur after a long-lasting trend is established, while double top pattern can be found after an established uptrend, and double bottom pattern appears after an established downtrend. Here is the examples of double tops. The double top technical formation starts with a bullish trend. The trend gets interrupted at some point and the price of the currency pair starts to range. The range consists of two swing tops on the chart. After the creation of the second top, the price action drops and starts a new bearish trend. Notice the example chart that the initial trend is bullish, but later it gets reversed after the double top formation. How to trade double tops or bottoms. 1. Recognize the major trend in the market. 2. Wait for the major top or bottom to form. 3. Wait for the price to test a support or resistance level, and then failure to exceed the price of the major to bottom. 4. After the minor top or bottom, wait for the price to close below the previous support level. 5. Enter a buy or sell in the direction of the new trend. Sell for double tops, buy for double bottoms with a stop loss above or below the double top or bottom. 6. Take profit based on your chosen exit strategy. Double bottom chart formation. The structure of the double bottom technical formation is absolutely the same as the double top pattern, but upside down. The double bottom chart pattern starts with a bearish trend, which gets interrupted at some point. The price action then enters a range, which creates two bottoms on the chart. After the second bottom, the price breaks the range to start a new bullish trend. Look at the double bottom chart pattern example. As mentioned, this is pretty much the same situation as the double top, but this time the price action starts with a bearish trend, which gets reversed into a fresh bullish move. Chart pattern 6. Triple tops bottoms. Triple top pattern. Triple top chart pattern is just an extension of the double top pattern. The price goes up again and finds another resistance near the same level as of the previous two peaks. In this case, there are 3 price peaks, all in a similar price area, as well as 2 retracements. Connect the 2 retracement lows with a trend line and extend the line out to the right. This line will be useful for trading and analysis purposes. Here is the examples of triple tops. The triple top pattern is similar in appearance to the head and shoulders patterns, in that it is represented by a series of 3 high highs and lows, except that with the triple top all 3 highs will be of an approximate level. How to trade a triple top. You can take a short selling position when the price breaks below the neckline. Please note that you may already have a neckline for the previous 2 peaks or tops, and the price action might have broken that before forming the third top. In such case, you need to enter the market when the price breaks below the lower neckline. Triple bottom pattern. Just like the triple top, a triple bottom chart pattern is an extension of the double bottom pattern. Triple bottom formations are reversal patterns with bullish sentiments. Here is the examples of triple bottom. This pattern is just opposite of triple top. This pattern forms in the downtrend. You can see the chart example on the screen. Chart pattern 7. Triangles. A Forex triangle pattern is a consolidation pattern that occurs mid-trend and usually signals a continuation of the existing trend. The triangle chart pattern is formed by drawing 2 converging trend lines as price temporarily moves in a sideways direction. Traders often look for a subsequent breakout in the direction of the preceding trend as a signal to enter a trade. Type of triangles. 1. Symmetrical triangle pattern. The symmetrical triangle is a situation on the chart where the tops of the price action are lower and the bottoms are higher. Also, the 2 sides of the triangle are inclined with the same angle. This creates the symmetrical character of the triangle. 2. Ascending triangle pattern. This triangle pattern has its upper side flat and the lower one ascending. In this manner, the tops of this triangle are on the same level and the bottoms are increasing. This type of triangle typically has a bullish character. When you spot this triangle on the chart, you should be prepared to catch a bullish price move equal to at least the size of the triangle. 3. Descending triangle pattern. The ascending and descending triangles are a mirror image of each other. As such, the descending triangle pattern has the opposite characteristic. The flat side of the descending triangle is below the price action. The upper side of the triangle is inclined downwards. In a bearish market, the descending triangle has a bearish potential equal to at least the size of the pattern. Trading with triangle patterns. Key things to remember. Always be cognizant of the direction of the trend prior to the consolidation period. Make use of upper and lower trend lines to help identify which triangle pattern is being formed. Use the measuring technique discussed above to forecast appropriate target levels. Adhere to sound risk management practices to mitigate the risk of a false breakout and ensure a positive risk to reward ratio is maintained on all trades. Here is the example of a triangle pattern. In the chart, we can see that neither the buyers nor the sellers could push the price in their direction. When this happens, we get lower highs and higher lows. As these two slopes get closer to each other, it means that a breakout is getting near. We don't know what direction the breakout will be, but we do know that the market will most likely break out. Eventually, one side of the market will give in. So how can we take advantage of this? Simple. We can place entry orders above the slope of the lower highs and below the slope of the higher lows. Since we already know that the price is going to break out, we can just hitch a ride in whatever direction the market moves. Quotation: you only need one pattern to be successful. Linda Bradford Rashka, Market Wizard. The key to being successful as a trader is not losing money in between the big moves, but staying in the market so you are there when the big move comes. Wise Trader Anonymous. We have presented the 7 chart patterns in this video. All of these patterns can predict moves in any pairs. Just grab a chart, sit down, and start marking patterns. They will soon begin to jump out at you. That's all for the lessons. If you like this lesson, please like and subscribe now. If you have any questions, please comment below, I will answer. Thanks everybody.